Hello there. This is GridCapital. Today the topic is yield. The definition is: yield is the amount of revenue earned through investments over a period of time. As a rule, the yield is expressed in percent, and the possibility of a negative yield value is also not excluded. It is crucial for investors to understand whether their investments are worthwhile, so it is best to comprehend how profitability is calculated. This figure displays the amount of interest income an investor might anticipate receiving over a specific time period, most often per year. The yields on stocks, bonds, properties, savings accounts, and other assets can all be calculated by investors. The most profitable alternative investment possibilities are selected by comparing them using this indicator. Each sort of investment's return is determined using a slightly different formula. If we use generalizations, it is often computed as the proportion of investment income to investment cost. The formulas used to determine the yields on stocks, bonds, real estate, and other investments might vary. The most frequently employed are: dividend yield, often known as return on equity investments, allows you to contrast the dividends a firm pays with the share price. Bond yields are a measure of the revenue generated for investors through the sale and redemption of bonds. Real estate profitability is a measure of the potential returns on real estate investments as compared to its market value. A general formula for a typical investment is a percentage return. Such a measure is known as anticipated yield, since it is not guaranteed if the yield calculation method involves non-constant information, for example, the stock price. This measure is characterized as known yield because the formula is based on stable values because the data in the formula is predefined. How is yield calculated? Which stocks may pay the highest dividends? The dividend yield formula makes this clear. In general, a greater dividend yield is a sign of a firm's financial health, but occasionally declining share prices can unnaturally raise returns, making them seem high even when the company may be in trouble. You can use the following formula to compare the yield of several bonds. The interest a bondholder receives from the issuer each year is known as the yearly coupon payment. The cost of a bond at the moment it was issued is known as face value. Bond yields can occasionally be negative. If this occurs, bond buyers pay in cash or the equivalent instead of earning interest on their investments, while debt issuers are compensated for borrowing. You can contrast the profit from investing in one piece of real estate with another by comparing the profitability of real estate, also known as net rental income. The difference between annual expenses and rent is your net rental income, such as taxes or utility bills. Real estate's value, not its value at the time of acquisition, is an indicator of its current value. A general formula for figuring out return on investment is the percentage return. These formulas can also have a lot more variables, though. They typically consider complex interest that accrues on interest, such as APY, etc. Difference between current and maturity yields. An alternative method for estimating the returns on bond investments is to use the current yield and yield to maturity. The annual coupon payment on a bond and the current bond price form the basis of the very straightforward formula known as current yield, or coupon yield. It reflects the overall yield of a bond assuming the investor does not resell it before the maturity date, making yield to maturity a more trustworthy calculation when the final payment date comes. The calculation is predicated on the investor purchasing the bond at its current price and making all required payments on time. Despite the fact that the calculation considers the long term, the rate is expressed in annual terms. Gains or losses from an investment or venture capital project are stated in dollars as returns. Revenue and returns are terms used to describe the money an investor has made or lost on investments over the course of a given time period. Between revenue and return, the rate of return expresses net income or loss as a proportion of the original cost of an investment. This is the formula is used to compute it.